opens with urgent energy. Silver just exploded to its highest level in over a decade, and if you're not paying attention right now, you could be missing the investment opportunity of the year. Here's what's happening. While everyone's been obsessing over Bitcoin and tech stocks, silver has quietly been setting up for what could be the most dramatic rally we've seen in precious metals since 2011. We're talking about a move that turned everyday investors into millionaires back then. But here's the thing, this isn't just about charts and technical analysis. There are three massive forces converging right now that have never aligned like this before. We've got industrial demand hitting record highs thanks to solar panels and electric vehicles, global supply chains tightening like a noose, and central banks around the world quietly accumulating precious metals at rates we haven't seen in decades. The question isn't whether silver is moving, it's already moving. The real question is, are we at the very beginning of a multi-year supercycle, or is this just a temporary spike that'll fizzle out like we've seen before? In the next few minutes, I'm going to show you the exact data Wall Street analysts are looking at, reveal why some major institutions are loading up on silver right now, and give you the three key indicators that'll tell us if this is the real deal or just another false alarm. But first, smash that like button if you want to catch these opportunities before they go mainstream. Let's dive in. Silver's spike, the start of a massive rally. Alright, let's get right into this, because what's happening with silver right now is absolutely fascinating. And I need you to understand the full picture before you make any decisions about your money. So we just watched silver punch through resistance levels that have held for years, and I'm sitting here looking at my screens thinking about all the times I've seen precious metals get hyped up only to disappoint everyone who jumped in at the wrong time. But this time feels different, and I'm going to explain exactly why in a way that actually makes sense. First, let me take you back to 2011, because that's the last time we saw silver do something truly spectacular. Back then, silver went from around $18 an ounce all the way up to nearly $50 in just a few months. That's almost a 300% gain in less than a year. People who got in early made absolute fortunes, and people who jumped in at the top got absolutely destroyed. The difference between those two groups wasn't luck, it was understanding what was actually driving the move and recognizing when the fundamentals changed. That's exactly what we need to figure out right now. So let's talk about what's actually happening in the silver market today. And I mean really happening, not just the surface level stuff you see on financial news. The first thing you need to understand is that silver is fundamentally different from gold, and this is something that even experienced investors sometimes miss. Gold is primarily a monetary metal and a store of value. Sure, it has some industrial uses, but the vast majority of gold demand comes from investors and central banks who want to preserve wealth. Silver, on the other hand, is split right down the middle. About half of silver demand comes from industrial applications, and the other half comes from investment and jewelry. This dual nature is what makes silver so explosive when conditions are right. Let me explain what I mean by that. When you have an economic boom, industrial demand for silver goes up because manufacturers need more of it for electronics, solar panels, medical equipment, and all sorts of other applications. When you have economic uncertainty or inflation fears, investment demand for silver goes up because people want to protect their wealth with precious metals. So silver has this unique characteristic where it can rally in both good economic times and bad economic times, depending on which side of the demand equation is stronger. Right now, and this is the crazy part, we're seeing both sides of that equation lighting up simultaneously. The industrial side of the silver story is absolutely massive right now, and it's being driven by trends that aren't going away anytime soon. Let's start with solar energy, because this is a game changer that most people aren't fully appreciating yet. Every single solar panel requires silver for its electrical conductivity. There's no good substitute that works as well or costs less when you factor in efficiency. The International Energy Agency projects that solar capacity is going to triple by 2030, and some analysts think even that estimate is too conservative. China alone is installing solar panels at a rate that would have seemed completely insane just 5 years ago. Each one of those panels needs silver, and we're talking about millions and millions of panels being manufactured every single year. But it doesn't stop with solar. Electric vehicles are another huge driver of silver demand, and this is where things get really interesting. A typical internal combustion engine car uses about 15 to 20 grams of silver for various electrical components. An electric vehicle uses between 25 and 50 grams, and some luxury EVs use even more than that. Now multiply that by the millions of EVs that are being produced every year, and you start to see the scale of what we're talking about. Tesla, BYD, Volkswagen, GM, Ford, every major automaker is ramping up EV production, and every single one of those vehicles needs more silver than the cars they're replacing. Then you've got the broader electrification trend that's happening across the entire global economy. 5G infrastructure, smart cities, the Internet of Things, artificial intelligence data centers, all of this requires massive amounts of electrical infrastructure, and silver is the best conductor of electricity we have. It's better than copper, it's better than gold, it's the absolute best, and when you need maximum efficiency and reliability, you use silver. This isn't some speculative future technology we're talking about. This is happening right now, today, all around the world. Now here's where the supply side of the equation gets really interesting, and frankly a little bit scary if you're thinking about future availability. Silver mining is incredibly challenging, and unlike what most people think, you can't just decide to mine more silver when the price goes up. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means even if silver prices double or triple, it doesn't necessarily lead to a significant increase in silver mining because the economics of those operations are driven by the primary metal they're extracting, not the silver that comes along with it. The primary silver mines that do exist are facing their own set of challenges. Operating costs have been going up across the entire mining industry. Labor costs, energy costs, equipment costs, regulatory compliance costs, all of it has been increasing steadily over the past decade. Many of the easy-to-reach, high-grade silver deposits have already been mined out. New discoveries are happening in more remote locations, deeper underground, or in areas with more complex geology that makes extraction more expensive and time-consuming. It can take 7 to 10 years from discovery to production for a new silver mine, so even if companies wanted to rapidly increase supply, they literally cannot do it quickly. And here's something that should really make you pay attention. According to the Silver Institute, we've been running a supply deficit in the silver market for several years now. That means global demand has been exceeding new mine supply, and the gap has been filled by above-ground inventories and recycling. But those inventories aren't infinite, and at some point, if demand continues to outpace supply, we're going to see significant pressure on prices. Some analysts estimate that at current rates of consumption versus production, we could see serious supply constraints within the next 5 to 7 years. Now let us shift gears and talk about the monetary and investment side of silver, because this is where things get even more compelling. We're living through one of the most unusual monetary policy periods in modern history. Central banks around the world have printed unprecedented amounts of money over the past 15 years. First it was the financial crisis response, then it was COVID stimulus, and now we're dealing with the aftermath of all that liquidity sloshing around in the system. Even though central banks have raised interest rates to fight inflation, the fundamental concern about currency devaluation hasn't gone away. When people start worrying about the long-term value of their paper currency, they traditionally turn to precious metals, and silver has always been seen as the more accessible option compared to gold. Think about it this way: gold is trading at over $2,000 an ounce right now. That's a significant chunk of money for an average investor to put into a single ounce of metal. Silver, even after its recent spike, is still under $35 an ounce. That means more people can afford to buy physical silver. And when you get that retail investor participation combined with institutional buying, you can see some really explosive moves. Speaking of institutional buying, this is something that's been quietly happening in the background that most retail investors are unaware of. Major investment funds have been accumulating silver positions over the past couple of years. Exchange-traded funds that hold physical silver have seen steady inflows. Some hedge funds are taking long positions in silver futures. There are even reports of family offices and high-net-worth individuals buying physical silver bars and storing them in private vaults. This kind of institutional interest doesn't happen randomly. These are sophisticated players with teams of analysts doing deep research, and they're positioning themselves for something. Here's another factor that doesn't get talked about enough: the gold to silver ratio, which is basically how many ounces of silver it takes to buy 1 ounce of gold, has historically been a really important indicator for precious metals investors. Over the long-term average, going back decades and even centuries, that ratio has been somewhere around 50 to 60 to 1. During the COVID panic in 2020, that ratio spiked to over 120 to 1, meaning silver was incredibly cheap relative to gold. Right now, we're sitting around around 70 to 75 to 1, which suggests that silver is still undervalued compared to gold based on historical norms. If that ratio reverts to the mean, and it almost always does eventually, silver would need to rally significantly even if gold prices just stay where they are. Let me talk about China for a minute, because what's happening there is absolutely critical to understanding the silver market. China is the world's largest producer of silver and also one of the largest consumers. The Chinese government has been very strategic about securing commodity supplies for its industrial base, and silver falls right into that category. There have been increasing reports of Chinese entities buying physical silver on the international market, and some analysts believe China may be building strategic reserves of silver just like they've done with other critical materials. If China decides to restrict silver exports or significantly increase its domestic consumption, that would create immediate and severe supply constraints for the rest of the world. Now, I want to address something really important before we go any further: market manipulation concerns. The silver market has a controversial history when it comes to allegations of price suppression and manipulation. There have been actual lawsuits, settlements, and regulatory actions related to banks manipulating silver prices through futures markets. I'm not going to get into conspiracy theories here, but what I will say is that any market where a small number of large players control a significant portion of paper trading can potentially see price distortions. What's interesting is that as physical demand increases and more investors insist on taking delivery of actual metal rather than just holding paper contracts, it becomes much harder to maintain any kind of artificial price suppression. The physical market eventually overwhelms the paper market. Let's talk about what technical analysts are seeing in the charts right now, because even if you're not a chart person, you need to understand what the traders are looking at. Silver just broke through a major resistance level that's been capping prices for years. In technical analysis, when price breaks through a long-term resistance level with strong volume, it often leads to continuation of the move. There's something called a breakout, and if it's confirmed, it typically leads to a measured move higher based on the previous trading range. Some technicians are projecting targets of $40 to $45 based purely on the chart patterns, and the more aggressive ones are talking about $50 to $60 if we really get momentum going. The moving averages are also telling an interesting story. The 50-day moving average has crossed above the 200-day moving average, which is called a golden cross, and it's generally considered a bullish signal. The relative strength index isn't yet in overbought territory, which suggests there could be more room to run before the market gets too extended. And perhaps most importantly, we're seeing consistent higher lows and higher highs, which is the definition of an uptrend. Trends tend to persist until something fundamental changes to reverse them. But here's what you really need to think about. Is this the start of a massive rally or just another false alarm? I've been studying markets for a long time, and I've learned that the most powerful moves happen when you get a perfect storm of factors all aligning at the same time. You need supply constraints, you need increasing demand, you need a favorable macro environment, and you need technical momentum. Right now, we're checking almost all of those boxes. The supply situation is tight and getting tighter. Demand from both industrial and investment sources is increasing. The macro environment with inflation concerns and currency devaluation fears is supportive of precious metals, and the technical picture is showing strength. Leveraged exposure to silver prices, but come with company-specific risks like management quality, operating costs, and mine life. And there are silver futures and options, which are complex derivatives that can offer huge gains or huge losses and definitely aren't appropriate for most investors. Here's something else to consider. Silver tends to be more volatile than gold. When precious metals are rallying, silver often, what concerns me, and I'm going to be completely honest with you here, is timing and sentiment. Markets don't move in straight lines, and silver is notorious for violent pullbacks even during bull markets. If you look at that 2011 rally I mentioned earlier, there were multiple 20 to 30% corrections along the way. People who panicked during those pullbacks and sold at the bottom missed out on the overall move. The investors who made real money were the ones who understood the fundamental thesis, had a plan, and stuck with it through the volatility. The other thing I'm watching carefully is sentiment indicators. When silver starts getting talked about on mainstream financial news, when your neighbor starts asking you about buying silver coins, when social media is flooded with silver memes and get rich quick stories, that's usually a sign that we're getting close to a top. Right now, we're not quite there yet. There's interest, there's momentum, but we haven't hit that euphoric phase where everyone and their grandmother is trying to buy silver. That suggests we might still be in the early to middle stages of this move rather than the late stages. Let me also address the different ways you can actually get exposure to silver if you decide this is something you want to participate in. There's physical silver, which means buying actual coins or bars and storing them yourself or in a vault. There's the advantage of holding the real thing, but you've got storage costs, insurance costs, and the spread between buying and selling prices can be significant. There are silver ETFs which hold physical silver and trade like stocks. These are convenient and liquid, but you don't actually own the metal. You own shares in a fund that owns the metal. There are silver mining stocks which can offer and outperforms gold on the upside. But when they're falling, silver often falls harder on the downside. This is because silver's smaller market size and dual nature as both industrial and monetary metal makes it more susceptible to rapid sentiment changes. If you're going to invest in silver, you need to be comfortable with significant price swings, and you need to have a time horizon that allows you to ride out the volatility. The geopolitical situation right now also plays into the precious metals narrative. We're seeing increasing tensions between major powers, ongoing conflicts in various parts of the world, and a general sense of instability in the international order. Historically, precious metals have performed well during periods of geopolitical uncertainty, because they're seen as safe haven assets that aren't tied to any particular country or government. If global tensions continue to escalate, that could provide additional support for silver prices beyond just the supply and demand fundamentals. I also want to talk about inflation and real interest rates, because this is crucial for understanding precious metals. When inflation is higher than interest rates, you have negative real interest rates, which means your money is losing purchasing power even if it is sitting in a savings account earning interest. Precious metals don't pay interest or dividends, so in a high real interest rate environment, they're less attractive compared to bonds or savings accounts. But in a negative real interest rate environment, precious metals become much more attractive because they at least preserve purchasing power while paper currency is being debased. Right now, even with interest rates higher than they were a couple years ago, real interest rates in many countries are still relatively low or negative when you account for actual inflation in essential goods. Let's think about the bigger picture for a moment. We're potentially at the beginning of a commodity supercycle driven by the energy transition, electrification, and infrastructure development around the world. Silver sits right at the intersection of all these mega trends. It's essential for solar energy, it's necessary for electric vehicles, it's critical for modern electronics and communications infrastructure. Unlike software or digital assets that can be infinitely reproduced, silver is a physical element that exists in finite quantities. You can't code more silver into existence. You can't print it like currency. You have to dig it out of the ground, and that takes time, money, and effort. The risk scenario we need to consider is what happens if I'm wrong, and this is not the start of a massive rally. What could derail the silver bull case? A major global recession that crushes industrial demand could do it. A significant breakthrough in alternative materials that can replace silver in key applications could do it. A major new silver discovery that dramatically increases supply could do it. A shift in monetary policy that creates very high real interest rates could do it. These are all possible, and you need to be aware of them, but based on what I'm seeing right now, none of these seem imminent. Here's what I think is most likely to happen over the next 12 to 24 months. I believe we're going to see continued strength in silver prices with periodic pullbacks that shake out weak hands. I think we'll test $40, and if we break through that level convincingly, we could see a move toward $50. The key is going to be whether physical demand continues to outpace supply and whether investment demand picks up as more people recognize what's happening. If both of those things occur, we could see something truly spectacular. Now, let me dive deeper into the mining sector itself, because understanding what's happening with silver miners gives us crucial insight into the overall market dynamics. The major silver mining companies have been relatively cautious about expanding production over the past decade. They got burned during previous boom and bust cycles where they invested heavily in new capacity only to see prices collapse before those projects became profitable. This means that even with silver prices rising, many mining executives are taking a wait and see approach before committing billions of dollars to new mine development. This hesitation creates a lag between rising prices and increased supply, which can amplify price moves on the upside. Looking at the environmental and social governance aspects of silver mining, There's increasing pressure on mining companies to operate more sustainably and responsibly. This is a good thing for communities and the environment, but it does add costs and complexity to mining operations. Stricter environmental regulations, higher standards for community engagement, requirements for renewable energy in mining operations, all of these factors increase the cost of production and make it harder to bring new supply online quickly. In some jurisdictions, it can take years just to get the necessary permits and approvals before a single shovel hits the ground. The recycling side of the silver market is also worth examining closely. Unlike gold, where most of what's ever been mined still exists in some form, a significant portion of silver gets consumed in industrial applications where it's not economically feasible to recover it. Think about the tiny amount of silver in a cell phone circuit board. When that phone gets thrown away, recovering that silver is often more expensive than the silver is worth. This means that unlike gold, which has centuries of above-ground supply available for melting and recycling, silver has a much more limited recycling stream. As industrial demand continues to grow, this consumption of silver in non-recoverable applications represents a permanent drain on available supply. I want to spend a moment on the relationship between silver and the broader commodity complex because this is important context. Commodities tend to move in cycles, and often when one commodity starts rallying, it signals that others might follow. We've seen strength in copper, which like silver is critical for electrification. We've seen volatility in energy markets. We've seen agricultural commodities respond to weather patterns and supply disruptions. When you step back and look at the entire commodity space, there's a compelling argument that we're entering a period where physical goods and resources are going to appreciate relative to financial assets. If that thesis is correct, silver is one of the best ways to participate in that trend. The monetary history of silver is fascinating and relevant to today's market. For thousands of years, silver was money. The word for money in many languages is the same as the word for silver. Spanish coins called pieces of 8 were the dominant currency of international trade for centuries. The United States used silver coins for everyday transactions until 1965, even after silver was removed from circulating coinage. It maintained its role as a store of value and a hedge against currency debasement. That monetary heritage hasn't disappeared just because we now use paper and digital currency. When people lose confidence in fiat money, they remember that silver has been valuable for as long as human civilization has existed. Let me address the psychology of precious metals investing because this is where many people go wrong. There's an emotional component to owning physical silver that's different from owning stocks or bonds. When you hold a silver coin in your hand, you're holding something real and tangible that has intrinsic value. That can be comforting during uncertain times, but it can also lead to irrational decision making. Some people become so attached to their silver holdings that they refuse to sell even when it would be the smart financial move. Others panic at the first sign of a price decline and dump everything at the worst possible time. The key is to maintain emotional discipline and stick to your investment thesis rather than reacting to short-term price movements. Looking at the options available to investors, silver mining stocks deserve special attention because they can offer leveraged exposure to silver prices. When silver prices rise 10%, a well-run mining company's profits might rise 30 or 40% because their costs are relatively fixed while their revenue increases with the silver price. This operating leverage can lead to outsized gains in a bull market. However, the reverse is also true. If silver prices fall, mining stocks can get absolutely crushed. Additionally, you're taking on company-specific risks like accidents, labor disputes, political instability in mining regions, and management mistakes that can hurt returns even if silver prices are rising. There are also streaming and royalty companies in the silver space that offer a different risk-reward profile. These companies provide upfront capital to miners in exchange for the right to purchase silver at a fixed low price or receive a percentage of production. They don't have the operational risks of actually running mines, but they get exposure to rising silver prices. Companies like Wheaton Precious Metals and Franco-Nevada have business models built around this concept, and they can be attractive ways to gain silver exposure with lower risk than pure mining companies. For investors interested in physical silver, the choice between coins and bars is worth considering. Government-minted coins like American Silver Eagles or Canadian Silver Maples carry a premium over the spot price of silver because they're guaranteed for weight and purity and are easily recognizable. Private mint bars and rounds are usually cheaper per ounce, but may have lower resale liquidity. There's also the collectible coin market, where certain rare or historical silver coins trade at significant premiums above their metal content value. That's a specialized area that requires expertise to navigate successfully. Storage and security for physical silver is a real consideration that people sometimes underestimate. Silver is much bulkier than gold because it's worth less per ounce. $100,000 worth of gold fits in a small safe. $100,000 worth of silver requires significant space and weight capacity. Some investors use bank safety deposit boxes, others use private vault services, and some store it at home with appropriate security measures. Each option has costs and trade-offs that need to be factored into your overall return calculation. The tax treatment of silver investments varies depending on how you hold it and where you live. In the United States, physical silver is considered a collectible by the IRS and subject to a maximum capital gains tax rate of 28% rather than the lower long-term capital gains rate that applies to stocks. Silver ETFs may be treated differently depending on their structure. Mining stocks are treated like regular stocks for tax purposes. These tax implications can significantly impact your after-tax returns, so it's worth consulting with a tax professional before making major silver investments. Now let's talk about the role of silver in a diversified portfolio. Modern portfolio theory suggests that adding assets with low correlation to stocks and bonds can improve overall risk-adjusted returns. Precious metals historically have had relatively low correlation to traditional financial assets, which means they can provide diversification benefits. However, the right allocation depends on your individual circumstances, risk tolerance, time horizon, and investment goals. Some advisors suggest 5 to 10% of a portfolio in precious metals, while others recommend more or less depending on the client's situation. The upcoming years present some unique dynamics for silver that we haven't seen before. The convergence of the green energy transition, the digitization of the economy, and the concerns about fiat currency is creating a situation where both the industrial and monetary demand drivers are firing on all cylinders simultaneously. Add in the supply constraints we discussed earlier, and you have the ingredients for a potentially historic bull market. The question is whether the market has already priced in these factors or whether we're still in the early stages of recognition. I keep coming back to the fact that despite all these positive fundamentals, silver remains relatively obscure in the mainstream investment conversation. Most people aren't talking about it at dinner parties. It's not dominating financial media coverage. Retail investment apps aren't plastered with silver promotions. This relative obscurity suggests that when the broader investing public does start paying attention, there could be a significant rush of capital into the sector that drives prices much higher very quickly. But you have to be smart about this. Don't bet money you can't afford to lose. Don't use leverage unless you really know what you're doing and are prepared to lose everything. Don't panic sell during normal corrections that are inevitable in any bull market. Have a plan before you enter any position. Know why you're buying. Know what would make you sell. Know how much of your portfolio you're comfortable allocating to something as volatile as silver. The investors who make real money in these situations are the ones who do their homework. Stay disciplined and don't let emotions drive their decisions. Position sizing is critical. Even if you're convinced that silver is going to the moon, putting your entire net worth into it is reckless. Markets can remain irrational longer than you can remain solvent, as the saying goes. A reasonable position size allows you to participate in the upside while not being financially devastated if things don't work out as expected. It also allows you to sleep at night, which is underrated but important for making good long-term decisions. So is silver's spike the start of a massive rally? Based on everything I've analyzed, the supply and demand fundamentals, the macro environment, the technical picture, the historical patterns, and the long-term trends, I believe the answer is yes. I think we're in the early stages of what could be a multi-year bull market in silver that has the potential to rival or even exceed what we saw in 2011. But I also know that markets are unpredictable and there will be obstacles and setbacks along the way. There will be days when silver drops 5% and you question everything. There will be weeks where it seems like the rally is over and you're tempted to sell. That's when you need to remember why you bought in the first place. The question isn't whether you believe me or not. The question is whether you've done enough research to form your own opinion and whether you're prepared to act on it intelligently. This isn't about following some guy on YouTube blindly. This is about understanding the fundamentals, recognizing the opportunity, and having the discipline to execute a plan. If you do that, regardless of what happens with silver prices in the short term, you'll have made an informed decision that you can live with. The next few months and years in the silver market are going to be absolutely fascinating to watch. We're at a potential inflection point where multiple long-term trends are converging, and the outcome could reshape the precious metals landscape for a generation, whether you decide to participate or watch from the sidelines. Understanding what's happening and why it's happening is valuable knowledge. Stay informed, stay disciplined, and make decisions based on facts and analysis rather than fear or greed.